Darren mentioned, I'm going to be tonight talking about where are we in the market right now, what's going on with the broad indices, and what can we expect from here from the market, based on the recent selling pressure we see in the market. We gave about a little over a week ago, we gave a sell signal to our clients, basically, telling everyone that we really wanted to be out of the market at this point, that it's a dangerous time to be heavy on the long side of the market. You had to be very selective, and you shouldn't have much market exposure right now, particularly if you're using a swing trading methodology as we do. It's pretty difficult trading right now, particularly on the long side. But for that matter, it really isn't an environment to try to get short in either. It's we're kind of in no man's land right now. Now, Darren had mentioned, where are we in the market? Are we in a major correction here? Are we just in a little pullback? What's going on? Well, taking a broad look here, here's the Compex. This is a daily chart. We've been in a rally, in an uptrend since the lows that were set last October, and since then, we've rallied quite a bit. We came off these lows, which the low here was about 2300, and we've rallied from the 2300 mark all the way up to highs of around 3130. So if you'll notice, I've drawn a couple of lines here. I have a trend line here. This is what I would refer to as the major primary trend. It's drawn from the dead lows of that last major pullback in the market, and you can see we've touched it a couple of times along the way on the way up. But basically the slope of this line steepened, and we actually ended up forming a secondary trend line right here. Now, recently, you can see we've broken below this secondary trend line, but we're right at support of the 50-period moving average. So, the point here is that even though we've broken out of a steeper trend line, we still have a major support level at the 50-period moving average, and so far we've been holding up at this level. Now, for us to have a true trend reversal, what we really would need to do here is set a lower high and then another lower low, and then we would be able to say that we're in trend reversal. But for the moment, that has not occurred. So what we would be looking for would be price action, something like this, where we would get, let's say, we would get a rally to this level somewhere in here. So let's say we got a rally somewhere in this level, and then if we pulled back to somewhere near here, let's say, we might pull back into here. Obviously, this was our last highest high. If we stopped here, if we rallied and we stopped here, that would be a lower high. In other words, this high right here would end up being lower than this high. And of course, if we sold off and broke below this low right here, so if we lost the support of this low right here, then we would have a new lower low established. So let's just say arbitrarily we'd stop right about at this level, about 29.25, something like that. Well, now we know we have a lower high and a lower low, so we have confirmation that the trend is reversed. At least the intermediate trend is reversed. But notice that even if we did pull back further, we have a major support level at this primary trend line right here. So we won't know whether or not we're just in a temporary pullback, or are we in a bigger correction until the market tells us. I mean, there's no sense in trying to speculate about it, because ultimately you'll find out. If we just continue to rally, and let's say we go sideways for the next 6 weeks or something like that, and we just stay in this trading range, and here the trading range I would be talking about is, let's say, from these highs right around 30.30 to the lows right where we touched the other day around 29.75. If we just stayed in this trading range right here and just chopped around sideways, price action tightened up, we could easily take another leg higher. But right now, this pullback is severe enough that if we don't break out of this, in other words, if we don't reverse out of this pullback in the next day or two, in all likelihood, we need to form a base here. We need to move sideways and get some consolidation for the next month or so in order to build a base from which to launch the next rally. So what are we looking for? We're looking for either a quick recovery and a rally to break above these swing highs. Obviously, that gives us confirmation that the uptrend is still intact. Or we're watching for, do we end up just getting sideways action within this trading range, and then break and then move higher? So the sideways action meaning that we would get, say, 30 days or 40 days or so of consolidation to build a base from which to launch the next rally. Or are we just going to break down here? Do we maybe probe above the 20-period moving average here, this brownish line? Do we just probe above that, probe above it, set a lower high? Here's the higher high, here's the lower high, and then break down, break this swing low? Then we know we're in a confirmed trend reversal. Now, once again, there's another major support level right here, so it doesn't mean that the market comes totally unglued, but it certainly would be a bigger correction. It would tell us a bigger correction is at hand, and we could end up, getting a 15 or 20% correction out of this. Now, what we do want to take a look at here that's important with the Nasdaq is key milestone. Notice this line right here. All right, what's important about this red line is we broke above this resistance level, which took us to new 11-year highs on the Nasdaq. So we've broken through a very important resistance level that took us to an 11-year high, dating all the way back to 2001. So that that's very important, a very bullish signal from the Nasdaq. And now the key becomes, do we hold this level? So basically, we see this 21 or 2870 level right here, 2870. That's a key mark. That's a key level that we really need to hold if, in fact, this is a clean signal and we're heading higher. But for the moment, that's very bullish. Now, also notice this 3130 mark, 3135. That's a major resistance level now. Do we consolidate here for a little while? Do we bounce between, let's say, 2900 and 3100? What happens next? But the longer that we hold up above this 2900 mark, and the more attempts we make at this 3135 mark, the more likely we're headed higher. And then after that, key resistance level, there's one at around 3530. And then, of course, you get up into this where the big breakdown took place back in 2001. But for the moment, that's I can't straighten up. That's a very bullish signal that we were able to break to new 11-year highs on the Nasdaq. So, and the Nasdaq has been the index that's really been leading us throughout this rally. If we take a look at the other indices here, let's take a look at the S&P, and we're going to see similar price action. If I expand out here a little bit, the only difference is the trend lines are slightly different. With the S&P, you'll notice the blue trend line. We're right at the trend line right now. We broke this secondary trend line, the black one. So now we're testing the 50-period moving average, just as we are on the Nasdaq. But our primary trend line is also right there. So we've got a good support level here, and if we were to come back down and retest this swing low, which I wouldn't be surprised if we do that right here, and this is true of all the indices, if we were to come back down and test this swing low, or even just undercut it a little bit, that would not be shocking. Before this market's been going up for quite some time now. If you go back the way to the lows of 2009, from March of 2009, we've had a rally going on for over 2 years, and this most recent leg of this rally has been going on since October of last year. So, typically in order for markets to base out, repair themselves, and go higher, you've got to have some shakeout moves. Well, the first of the shakeout moves is in place. We've knocked a lot of people out of the market, or at least people are wary enough to be a little bit respectful of what's going on out there. We just had this big move down here into the 50 period moving average. What would be ideal, believe it or not, would be to actually set a lower high, maybe rally up to 1400, and then come back down and undercut this 1356 level, around 1350. Have a big undercut and maybe, undercut down into somewhere around here. In other words, the market sells off, we undercut the swing low right here, we come down until, let's say, 1350-ish, somewhere in that range, 1349, scare the heck out of everybody, and then reverse off of that. That's the kind of price action that you want to see. You really have to shake everybody out of the market here. Really make everyone a true believer, create some fear, some panic out there, and get everyone thinking that it's all over, that the rally's dead. And the only way we're going to accomplish that, in my opinion, is typically you get a big undercut of the most recent major support level, which would be this swing low right here. So I would not be shocked at all to see a retest of this low if in fact we are to head higher. If it doesn't hold, if we get a shakeout move and it doesn't reverse very quickly, and typically what will happen is it will occur in one day. In fact, if we go back in time, you can see here we had this swing low going back to last summer. Then we tried to form a bottom, and we had a big shakeout candle right here, this one right here. We undercut this swing low, scared the heck out of everybody. But notice, within that same day, the market reversed. We had set a new low, broken through that swing low, but then went on to close near session highs. That's the kind of candle that we would be looking for. That's the kind of price action we'd be looking for. Now, it can take weeks. In other words, you see how we chopped around here. I mean, that was some violent price action during that time, and we were short during this time. We made good money, but a very violent price action. So, we could have a situation where over the next several weeks, we test this level a couple of times and then make a major test of it just like this. Or it can even occur such that you just come down, make a major test of it in a day or two, and then just, take off and go higher. Once again, that assumes that we are headed higher. If not, we'll know quickly because we won't hold this support level. We'll lose support here at this 1356 mark, and we'll set another lower high and another lower low, and then we'll know that that the market is in a bigger correction. It's not just a minor pullback. So I guess the more of the story right now is that we're still in a broad bull market, a long-term bull market. Right now we're in a short-term pullback, and what we have to determine now is the short-term pullback going to turn into consolidation? Are we going to consolidate and move higher, or is this going to turn into a bigger correction where we set a lower low? Now, looking at the Dow, you'll notice the Dow has actually done something that's a little more negative than the other indices, or at least could be. Let's draw a line here. Whoops. The Dow actually set a lower low here compared to this previous swing low, slightly lower low. And now, the potential exists. Do we set a lower high and then sell off, end up with another lower low here? Let's say come down to like 12,600 or 700. Once again, I think the big message here is that to a great extent, we're in no man's land in the market. That's why we have a sell signal in. When you get to this point in the market, when you're starting to see accumulation of distribution days, where a distribution day is defined as days where the market is, an index is down by 0.3% or more, okay, and volume is higher. So what we've seen over the past 3 or 4 weeks is that we've had an accumulation of distribution days where the market has been lower by 0.3% or more, and volume has been higher on those days. And so, we put in a sell signal, And you'll notice trading is very difficult. Anyone who trades actively on a day-to-day basis will certainly certainly notice trading has been difficult over the past couple of weeks because there's really no definitive trend in place. It's very choppy, and there's very little follow-through on either side of the market. I can't stress enough that just because we have a sell signal in doesn't mean we want to get short here. Reason being, we're still in a long-term uptrend. The major trend has not shifted, and to get short here is also very dangerous. You're typically you're best off just being on the sidelines until you get the next buy signal. So, if we one reason you got to be careful in markets like this when you get to situations like this is that things can deteriorate very quickly. And let's just take a look at something here. If we look a little bit at psychology of markets, okay. I always use this as an example. It's something that gives a pretty good indication of the power of market psychology and what can occur and how quickly it can occur. All right, if we draw a horizontal line here on a much broader long time scale, I'm going back from the 1980s all the way to present. This is just looking at the Dow. Now you'll notice that the Dow for many years was in a trading range between 500 and 1,000, and then finally around 1982 it broke above that 1,000 level and has never never looked back since then. And we went from about 1,000 all the way up to 14,200 right here back in late 1997 when we hit the all-time high there on the Dow. So what took from 1982 to 2007, that's what, 25 years, 25-year move. Then in the bear market, the financial crisis of 2008, 2009, what took 25 years to build, in about a year and a half or so, about a little less than 2 years, we wiped out over half of that move within 2 years. So 25 years worth of move, half of it wiped out in 2 years. That gives you a pretty good idea of the power of fear. Market fear is simply the strongest emotion in the market. It's kind of a macabre saying, but I have a little saying that you don't see people jumping off of buildings because of greed, because they're making a lot of money. No one jumps off a building because they're making a lot of money. But certainly during fear, when people get wiped out, people jump off buildings. I mean, it's a sad fact, but the reality is it sort of drives home how strong that emotion is and how quickly you can erase major gains. So my point to all this is not to be morbid, but when you get into times like right now where we're kind of in no man's land, where we're still in a longer-term bull market, but we have sell signals right now, this is where you have to be careful, because notice in 5 days here, we wiped out, a month and a half, 2 months worth of rally in just 5 days. So if we are in more of a bullish or bearish correction, you can wipe out 6 months worth of rally in a week. And that's why you have to be careful during these times. That's why you're better off being, lightening up in the market. Lighten up, and of course we wait for the next buy signal. So, I think, in a nutshell, just to recap, I think we're currently still in a long-term bull market. We're still in a trading range. So we haven't breached these lows right here. We're still in a trading range in all the major indices. And now it's just a question of whether or not are we going to build a base here and take another move higher, or do we set a lower low and do we have a trend reversal in place? And that's really what it comes down to. And it's during this time where you're best off just staying out of the way until the market tells you where it's headed. Because if we do set a lower low, then we're going to see a lot of shorting opportunities come into the market, and a lot of setups that are going to offer us the ability to go short. If we consolidate, we're going to see that the stronger stocks and ETFs are just going to consolidate at their highs, and then when the market eventually does turn, they'll be the first ones to break out. So this is one of those times where you just got to sit on your hands and wait and see how things unfold. So, Darren, that's kind of covers everything I had to say about current market conditions, and I'm going to turn things back to you.
Thank you very much, Ed. Ed spoke some really insightful things there. It's not only about the charts and what we anticipate is happening in the market, but the psychology. And that's one of Ed's strengths. In fact, he wrote a whole chapter about it in our next book about market psychology. It's something that people fail to realize is that markets fall a lot faster than they go up. And it was a great example with the monthly chart there of, how we gave back 25 years of gains. We give back 50% of that in just a 2-year, less than a 2-year period. And that's why we have very precise market timing signals that tell us when to get out of the market. If you look at our historic track record, our performance of our newsletter over the past 10 years, it's on our website. You'll see that we have a very consistent return that outperforms the S&P. But more importantly is the fact that we actually have a very well-proven market timing model. Some of our newsletter subscribers, in fact, most of them subscribe because we give individual stock picks and ETF picks with, exact entry and exit points. But we have quite a few subscribers that subscribe to our newsletter purely for the market timing model. They don't even trade our stocks or the ETFs we recommend. They have their own stocks they trade, but they just need help to know when they should be in and when they should be out of the market. And we've got a proprietary model that works very well. In fact, we'll be publishing an article within the next few days that proves that. It's really important to know when to get out. I mean, we were heavily long the market, in fact, in our newsletter through most of this 2012 until about 2 weeks ago. And our market timing model got us out within less than 2% of the 52-week highs of the S&P and the Nasdaq. And then the market proceeded to drop several more percent and could go even lower. But now we got out quickly. We locked in our gains, and now we're sitting primarily in cash, waiting for the market to make up its mind and show its hand. So, market timing is important to know. Otherwise, you risk getting wiped out. Okay, so good stuff there, Ed. Thank you very much. I'm going to turn things over now to Rick, and Rick's going to share with you some individual stock picks that he's got his eye on. Now, again, just to confirm, we are presently in sell mode, so we're not actively looking to buy the market, okay? But it's important to have a watch list of things that you do like, so that if when a market stabilizes, and let's assume it starts heading back up, these leading stocks that are showing relative strength now, these are going to be the first stocks to head back up as well. So, Rick, I'm going to turn things over to you right now.
All right, thank you very much. Good evening, and let's get right to it here. All right, why did our timing model generate a sell signal? I'm not going to get into the specifics of that. It's some proprietary information and some fairly obvious distribution days in the market, though it's not always so obvious to some people. For more experienced traders, it is. So a combination of bad price action in stocks and bad market action led us to a sell signal on 4-4. And in our newsletter, we reduced our exposure from 150%, that's 50% margin, to less than 50%. On the very next day on the open, within the first half hour of trading, we're out of everything completely. This basically was due to the market timing model telling us to get out of the market because the odds of the market selling off were very high at that point in time. So what do we do next then? Well, when we're in a sell signal, we basically sit on the sidelines in cash waiting for a buy signal. And while we're doing that, we like to keep a list of stocks that are acting, they're holding up relatively well versus the broad market that are holding above their 50-day moving average. And I keep a few stocks. I keep a running watch list, and that's updated each and every day. And I'm going to share with you guys a few setups that we're currently looking. With the market under selling pressure right now, we really don't want to. I mean, you could possibly be in one or two longs, but for the most part, you want to be sitting in cash. So these are not setups that you want to take put a big chunk of your capital into yet. So first up is CRI, Carter's Inc. As you can see, it's already broken out to new highs here, which is great relative strength. However, volume has been pretty light. which is not a good sign. Well, which leads me to believe that it will pull back eventually to this $50 level, or potentially form a flag here over the next week. That would be a potential a stock that we look for a buy entry in next week if the market were to turn healthy. Another potential setup, recent IPO, LinkedIn, and we really like LinkedIn. It simply needs a few more weeks of consolidation below, I'd say in between this range right here. Definitely want it to hold above this most recent swing low, maybe another 2 or 3 weeks sideways, and that should develop the base. I mean, what we basically look for is at least 5 to 7 weeks of basing action before we enter a stock, and that lets us know that there's institutions involved in the stock, and they're the ones holding it up and forming that pattern. Next up is Fortunate, FTNT, false breakout. It's holding up well the 50-day MA, and during the market selling off, we really want to see stocks hold above the 50-day moving average. If the market, well, since the market has broken below the 50-day MA, although the Nasdaq's right around the 50, but it's a good sign when they hold above the 50-day MA overall. TDG, 50-day MA, viewed last week and has stormed back above the 50. We look for some sort of handle to form here and a pullback to the 118 area. As long as it holds above the 50-day MA moving forward, this should be a setup that's in play. And the last setup here is UA, and it's been holding up fairly well here. Very nice pattern. We'd like to see a few more weeks sideways in between the 98 to 95 level. And the last part of my presentation, I'm going to go over, well, how do you know what kind of market we're in terms of, are we going to pull back? Kind of some of the questions that Ed asked about, presented you guys with. How do we know that we're in a short-term correction here for a few weeks, or, rebuilding a nice base, or are we going to sell off, have a sharper sell-off? And that really depends on the stock patterns themselves that make up these indices. So, for example, more stocks started looking like Molina Healthcare, something that was healthy, that broke down, I would be very nervous right now in the market. But fortunately, that's not the case, as I've shown you five or six patterns here that have held up pretty well. And I think that's the case for the majority of stocks I've been scanning each and every night. It's not so bad out there. There's another example of what you don't want to see happen. These are good stocks that just got blown up within a week or two. So if you see more of these type of patterns, and here's guide, tight pattern at the highs and breaks down. Zenga, nice IPO here, breaks down. So so far this kind of selling's been limited, but when you see this wholesale selling in some of the top leadership stocks, and if the market is about to sell off, or if the market is shaky or we move to new lows, combined with these stocks breaking down heavily, you really want to step aside and just stay clear of the market. But until then, so far it's looking pretty good, and we'll just have to see. As Ed said, we'll have to wait and see for the confirmation of the next buy signal. So that's all I have for tonight, Darren. You can take it back.
One point that Ed made there, which is is similar to what Rick was talking about, is the importance of market timing. And one thing that Rick emphasized is looking at leading stocks, the performance of leading stocks. There's several signals we use. We don't only look at the broad market, which Ed talked about. It's a combination of factors. One thing is also the leading stocks. Without leading stocks, generally a market's not going to hold up. But if the leading stocks are holding up well, then the market will. So it's one thing we closely monitor is the performance of leading stocks, primarily small to mid-cap stocks as well. We've got about 15 to 20 minutes left before we have to wrap up. Bear with me here. I'm going to just for 1 or 2 minutes just talk briefly about what we do, and then I'm going to open it up to questions, and we'll give you answers. We can answer any questions that you have about what we talked about this evening, or about our trading strategy, or our thoughts on any specific stocks or anything like that. For those of you who are not familiar with us, this is our website that you see right here, morpheustrading.com. One thing I highly recommend you do, which is free, by the way, is go to our website and then click on the button that says our blog. And you will get, there's literally hundreds of articles on there, educational articles about our swing trading strategy and what we do and how we do it, and all kinds of great resources on there. Every day we post a video with our trading ideas, and just a lot of good wealth of material on there. So please check out our blog. That's our website. And for those of you that want to actually really participate in what we do and on a greater scale, we do have a newsletter called the Wagner Daily, which is a nightly newsletter. It's 100% end-of-day trading, which means that it's designed for people that have daytime jobs that can't follow the market during the day and make intraday trading decisions. Everything's based on end-of-day trading decisions for the best stocks and ETFs. It's a trend trading methodology. There's nothing magical about it. We simply follow the trend. But what is important, though, and as I mentioned earlier, what a lot of people pay for is just our simple market timing model, which has a very good record of accuracy, and you can see that if you go to performance here, if you click on the performance tab of our website. So it looks like it was my internet connection that was the problem. Here's our blog. You can see here a lot of good information. There's our daily videos, and then if you come up here along the right side, you can click on recent posts, popular posts. We got an archives. There's a video here. If you haven't seen this yet, check this out. Our swing trading strategy. It's a 12-minute video that explains an overview of exactly what we do, how we take swing trades. So check that out as well. So there's a lot of good free material in there. Let's go ahead and dive into questions and answers. We got about 10 to 15 minutes here for your questions and answers. So the way this works is click on the button that says chat on the Go Meet Now control panel and just type in your question. How do we avoid buying a false breakout?
Bob, you really can't avoid buying a false breakout. However, you can. I mean, I don't want to go into too great a detail on this because, I mean, this is essentially one of our proprietary, this is what we do to separate the good and bad stocks. But you basically, if you see a false breakout already there, that's a pretty good sign. If there's not a false breakout in the stock, then maybe it's something you might want to wait on. But if all of us get caught in false breakouts, all you have to do is just realize it pretty quickly. Maybe cut your size back a bit, or all of it, and then re-enter if the setup still looks good. Can't avoid it, But
false. I was just going to say false breakouts are part of the business. I mean, they happen a lot. The key is to identify it quickly and get out. And one thing that a lot of new traders have trouble with is re-entries. If you get stuck in a false breakout, simply get out and wait and watch the stock. And if it sets up and it breaks out again, just get back in. Oftentimes, the second breakout attempt is the one that's successful and follows through to the upside. The second breakout is often the one that leads to the bigger gains. When I was a new trader, in fact, I remember many, many times it happened where I'd get stuck in a false breakout, I'd sell, and then the stock would go back up and go back above where I sold, and I'd say, well, now it's going, but I don't want to buy at a higher price than where I sold, so I'll just leave it go, only to watch the stock go up, 10, 20, 30%. So what I eventually learned is that you can't be afraid to re-enter stocks. If they still look good, you have to re-enter even if it's higher. What I eventually learned is, okay, I could miss out maybe on 1 point because I'm paying a point higher to buy the stock, but still it's better to make 9 points gain out of a stock. Maybe you don't make 10, but better to make 9 than to make nothing. So that's the main point I wanted to make about false breakouts. They happen, as Rick mentioned, and they're simply a part of the business. It's not a big deal when it happens. Just get out. But then it's important to reassess. Okay, Mike is asking about TNH. Rick, since I have the desktop turned over to you, do you mind going over the TNH there?
Okay, TNH, tight breakout from 25%. Nice move out. Usually the first pullback to the 20-day EMA is buyable, but this is so much volatility here. I really don't. This isn't exactly what we look for in a pullback to the 20-day EMA. So the big volume, it's just too much volume, too wide, too loose. The only way to have a tight stop is to see, when you have volatility, you can't have a tight stop, and that's basically the only way we like to trade is with the tight stop. If you start having your stops 10% wide, then I mean you have to make like 20-25% return to get a 2-to-1. So definitely, it's just too much volatility right there on the pullback.
Marty is saying, where can I find information on monthly subscription cost? Marty, just to answer your question, the details are actually, if you just go to our website, fill in your name and email address, then you'll get subscription options. But it's basically $79 a month, or $199 a quarter, or $699 a year. So on a yearly basis, it works out to be $58 a month, or less than $2 a day. 3 different choices, but you'll see that. And we have a 30-day risk-free guarantee, so you can test drive our newsletter, and if you're not happy with it, then we give your money back within the first 30 days. So it's a good way to test it out. So, yep, we'd welcome you to try it out, obviously. Okay, Anthony's asking about PSMT.
Okay, price smart. Kind of a wide range breakout here. I mean, wide range consolidation, very loose, and pull back to the 200-day moving average. It's a little bit too wide and loose here for what we like to do, and it's already made its move, and now it's trending higher. I mean, as a buy entry, it's breaking out to new highs when the market's weak, so that's a sign of relative strength. But I don't know if you're going to get a ton of fall through. So if you're an entry here, it's tough. If you're, maybe on a pullback, you might be able to see a 3 to 5 day pullback, maybe. That might be a bit of a better entry, and by that time the market may be, acting a little better. But right now, breakout entries are going to be really tough for them to succeed, as they're going to have no help from the market, so they're on their own.
All right, Dynamite is asking about the yen, specifically FXY or USD JPY. Which is ETFs.
All right, the yen. Well, when you see a big breakdown like this, where we've lost all the moving averages, I mean, obviously we're no longer in an uptrend in the yen, and we're below all of our moving averages. We've had the death cross here, where the 50 crosses below the 200. The 200 starting to flatten out now, and slightly sloping lower, which isn't generally a good thing as far as the yen is concerned. And what I like to do when you get a big move like this, a big blowout move like this, I like to go to longer term charts, take a look at like a weekly chart, and you'll notice what's happened here is the yen was, since 2008, 2007, in a very consistent uptrend where it just rode along its 50 period moving average. Notice here, the blue line is the 50, right? This blue line right here. So we consistently held the 50 period moving average. There's undercuts, and that's fine. I mean, you're going to expect some undercuts. Here, we had a lot of touches, and then finally, recently, we lost support of the 50. So now we still, this is where you get into what I call that no man's land area. We certainly broke below the trend line. Notice the trend line right here. I'll change colors. We broke below the trend line, and we lost support of the 50 period moving average. And even on the weekly chart, the 20 has crossed over the 50, which is pretty bearish. So we're going to see a lot of resistance here on any rallies back up into this 20 and 50 period moving average on the weekly chart. And if we go back to the daily chart, we're going to see the same thing.
Looks like a short
to me there for a minute.
On intermediate term short.
Yeah, exactly. And coming back to the daily chart, I mean, that's what you're seeing. Right now, you're up into resistance. It was repelled by the 50 period moving average. Notice how we overcut it and it sold off. This would take a long time to repair itself in order for it to be, a long entry. Right now, I would welcome it to rally up into the 200 as a shorting opportunity. And quite frankly, it might just chop around here and offer a shorting opportunity right where it's at right now. But definitely would stay away from it on the long side. At a minimum, it's probably trapped in a trading range for quite some time, with the lower end of the trading range being here and the high end of the trading range being at these highs.
Ed brings up a really good point here. I'm sorry, Ed. Ed brings up
No,
a really
that's
good
okay.
point about the importance of looking at multiple time frames. You can't only look at the daily chart. The daily chart shows you what's happening right now, but the weekly chart really gives you an idea of the big picture and eliminates a lot of the chop and the noise, as I call it. On this weekly chart, you can see that we're breaking down. Ed, if you can pull up the weekly chart there, you can see that we're in danger of breaking this multi-year uptrend line. In fact, I would go ahead and go out on a limb and say it's probably already happening. I mean, we undercut it once. Now it's. I'd be very surprised if we go back up to the highs here anytime soon. Next move down probably tests the swing lows from earlier in the year. This is something that I like as a short sale, not a short-term short sale, not like a 1 or 2 day trade. We're talking intermediate term, several week trade, which is mostly what we do. On the daily chart, if it gets back below the 20 period moving average on the daily, that's a potential entry, something we would consider. And we do trade ETFs because the nice thing about ETFs is that they have low correlation to the direction of the main stock indexes. The direction of the yen is very low correlation to what happens in the S&P or the Nasdaq. So, we give our subscribers, a lot of diversity by trading both ETFs and stocks. Bruno is saying, is your sell strategy to sell into strength or wait for a trailing stop to get hit? Very good question, Bruno. The answer is it depends. It really does depend on market conditions. I mean, if we are in a very strong market, like we were until within the past several weeks, prior to the past several weeks, then usually we'll sell in the strength. Generally, we look for a 2-to-1 risk-reward ratio. So we set our initial stop, and if the initial stop price is, let's say it's 4% below our entry price, then when we're up about 8% on the trade or more, we'll look to sell into strength and take profit, at least on partial shares, sometimes the full position. That's what we do in a strong market. We'll sell into strength. We set targets, in other words. But in a market such as what we're in now, where it's more of a trading range or there's more indecision, if we get a little bit of a gain on something and it starts to deliberate or kind of stall, then we use trailing stops and tweaking them in as we're able each day in our newsletter, just raising the stop. So there is no yes or no to your question, Bruno, but it's a combination of both depending on market conditions. So let me go ahead and look at the next question here. Right, so Mike is saying, what kind of volume confirmation do we look for in a breakout? Well, Mike, what we'd like to see, if a stock is showing relative strength and breaking out, what you want to see is you want to see volume be two things. First of all, obviously it needs to be greater than the previous day's volume, but more importantly, we want to see it spike above the 50-day average. You see on the chart that Ed's looking at there, and all his charts, he's got a green line running across the bottom on the volume. That's the 50-day average volume. And that shows you what the average daily volume of that stock is, or the ETF is, over the past 50 days. That's important because more than 50%, in fact, probably closer to 60-70% of the stock market's average daily volume is controlled by institutions. That means banks, mutual funds, and hedge funds. And what they do directly determines what the market does. So, if the big boys, so to speak, are selling, then the market is going to have a real tough time going up. Likewise, or conversely, if the big boys are buying, you're going to have a hard time selling short and making any money. So that's why volume is such an important indicator. And when we look for breakouts, we want to see the confirmation of institutional backing. So institutional backing generally would be found when you see a volume spike. On this chart that Ed's showing you right now, Egypt, there was a big volume spike a while back, but see, this is an ETF. So ETFs volume is less significant because ETFs are synthetic. So, they're not going to necessarily be, go up a lot or go down a lot with a volume spike, but with stocks, it's quite different. So we pay less attention to volume in ETFs, and we look more at the individual stocks within that ETF in terms of volume. So we have time for like 1 or 2 more questions here. Let me see. All right, Bob's got a long question for us here, so let's go ahead and answer Bob's question.
Let's see your question. Bought CRI early in the most recent breakout, starting with 1/4 of shares I would like. I'd like to slowly scale into a few more shares. Shares can be bought at the low on the flag forming. Would stop at 49.90 be a good risk point? All right, let's take a look at CRI here. 49.90 stop. I mean, that's a pretty tight stop. 49.90. I mean, it's likely it'll get hit if it's that tight. I mean, if you're trying to protect, the fact that we have a sell signal in the market, and if your goal is to protect and not take a loss in CRI, then I would say, yeah. I mean, if that's going to break even or get you a small profit out of the trade, that's not so bad. But it's fairly likely that stop would be hit. That's a very tight stop. I mean, if you want to try to ride the trade, your stop would need to be below here, but then you're taking on some risk in a market that's that we have a sell signal for. If we didn't have a sell signal in the market, then certainly it's a lot easier to be confident in holding a wider stop, and I would most certainly do that. And once I got, let's say, 10% of the money, then I'd look to move the stop up. But I just really think that comes down to if you're trying to protect a winning trade and you just don't want to get caught in the crossfire. It wouldn't shock me if CRI fell back into the trading range here. In other words, that we ended up with a false breakout and that we fall back into the trading range. It very easily could happen. If the market puts in an accumulation day and we get a buy signal back, get some continuation, then CRI could just take off from here. But I'd have to say that's a pretty tight stop. 49.90 just seems likely to get hit. So it really comes down to your risk appetite, I guess. Otherwise, I'd be putting the stop much lower. I'd put it below this swing low right here.
All right, so that concludes this evening's webinar. Thank you very much for attending. Again, this is our website for those of you that are new to us, morpheustrading.com. Take care, everyone. Thanks for coming. I hope you have a good night, and see you at the next webinar.